Okay, I think we'll get going. Lois, it's you and me. We had some other people that have signed up. We haven't seen them on, and the way these things tend to go is people will log on at some point, but let's get going. We have stuff to talk about. Good to have you here. All right, so what we wanted to address today, because there's tends to be a lot of questions around how that homeowners exemption works. And we know that there were some changes with the homeowners exemption. And then there was an interesting concept. Lois, you'll know the Groves. This was C. Scott Grove, who is a state legislator now. And he proposed an interesting change. And so we're going to talk about all of those. Okay, so if you are familiar with it, the homeowner's exemption, well, let's talk about your property taxes first. So the county is the one that addresses your property taxes. And so you pay property taxes each year based on the value of your house and the property that the house is on. And we've seen the values appreciate over time. They've increased in value, even though people haven't really done much. As far as improving the value of the property. In some cases, they've done little or nothing. In other cases, people, have maintained the house, of course, and or the property, and it's appreciated in value. So to address that and try to keep it fair across the board, the state legislature years ago said, well, listen, let's do a homeowner's exemption. That's for people that own the home. So if you're renting out the property to someone else, doesn't apply. If it's a business, it doesn't apply. So the homeowner's exemption was put into place, and the homeowner's exemption addresses 50% of the value of your property. So it's your house and the 1 acre that goes with the house. So if you have 5 acres, they're gonna apply it against just the 1 acre. Don't ask me how they figure all that out. That's what they do. And of course, they send you a notice of the assessment of the value, and then they apply the homeowner's exemption on there. That's not your bill. You get that later, but there's an assessment that tells you how what they've determined the value of your property to be. So half of that gets exempted. We'll see some examples of that in just a second. And there's been a real concern because recently, over the last 3 or 4 years, the value of properties, especially here in the Boise area, down here in the Treasure Valley, and evidently actually everywhere in Idaho at this point, those property values have shot up. And what that would mean is the taxes would shoot up. And I know that in our neighborhood, the value of the properties has doubled in about 4 years. And so property taxes, of course, have doubled along with that. Well, the legislature this year said we've got to increase the amount of the homeowner's exemption to give homeowners a break. And this was passed on like the second to the last day or the last day of the legislature earlier this year. And they added $25,000 to the exemption amount, meaning, so half of the property is exempt up to $1,000 or $100,000. So $100,000, you take that off, and then they apply the tax to the rest. This year, the state legislature like I said, in the very last days of the session, passed a bill that increased that amount from 100,000 to 125,000. This was after, of course, that they promised and committed to making some changes so that we wouldn't get caught up in all these taxes. And as it turns out, 25,000 was it. And I know 25,000, that's 25% of what they were doing. So they jumped at 25%, which of course, property values, doubled. They went up 100%. So they didn't really keep pace with the appreciation in the property. But it's helpful. Just, we were kind of thinking they'd do a little bit more for us. Well, 25,000 was it. And actually it's the taxes on 25,000 that they really changed for us. So let's just take a house. We picked one and we looked at some values. It's a 4-bedroom, 2.5 bath, 2,183 square feet, and located in Garden City. Now you could apply what we're going to do to almost any house if you've tracked the values. So this is how it works. The assessed value, of course, in 2021, 446,000. Now I'm telling you that in 2017 it could have been 260, 270,000. So that's jumped up quite a bit. So here's the assessed value. You got the notice, you got the assessment, right? We subtract out the homeowner's exemption. They'll do that on that notice that you get. So the taxable value is 321,000. And the property tax rate for 2020 is 1.014%. And that's actually for both Ada County and Canyon County, that 1.014%. So if you're saying, well, that's not the same as in other counties, that's true. That each county develops what the percentage is for property within that county. Just so happens that here in the Treasure Valley, it's consistent between Canyon County and Ada County. So then the tax rate the taxes then would be $3,254, $3,255. Now you could just take the 1.014%. I didn't do that earlier, but I'm going to do it right now. I have a calculator. I have one that I've had for 20 years. It's a Casio, and it still works. It's about all I can do. So if we had taken that on the whole amount, say we were renting out the property and we didn't get the homeowner's exemption, we'd take the 1.014% times the whole amount. So 446,000 times the 0.1014. So that would have been $4,522. So we saved $1,300 with the homeowner's exemption. Okay, so that's how that works. We got to exclude 125,000 of the value, and then we apply the percentage to that number instead of the total value. Okay. Now, if you're familiar with Zoom, you can, in the chat box, you can chat in and type in questions if you have them as we go along. All right, so a couple of things. How does the homeowner's exemption interact with your trust? That's kind of the first question that we have to answer. So if you're sitting there, you've been in your home and you have a homeowner's exemption, and then we create a trust and we move the property into the trust. Once we do that, that's a change in ownership down at the county recorder's office, and the county recorder's tied into the assessor's office, who, they do the tax part of it. So that triggers then, that change in ownership triggers the assessor's computer that says, oh, there's been a change in ownership, and they'll kick out the homeowner's exemption, and they'll send a letter to the homeowner and say, do you want to continue your homeowner's exemption? And then they send some documents that you fill out and send back in, and that's what allows them to do that. Now, I put on here that Patty and Beth will help you with that. Typically, when we're doing a trust, we have you sign, we know what documents they're going to send out in Canyon County and Ada County. And so we have you sign those documents while you're here, and then ask you to let us know when you get them from the county assessor's office, because then we know that they've recorded the deed, the property is now changed title into the trust. And they'll send you those documents, and you don't have to worry about them for the most part, but call and say, hey, listen, we got these and we got the documents. We've kept track of that. And if we've had you sign that already, Beth or Patty's they're going to say, yeah, you already signed them, you're good. Those have been submitted. You'll be fine. But then you have to keep an eye on, make sure that they follow, that the county is followed through. Okay. So that's how that works. Those documentation, there's an affidavit, and you have to sign that. And so if you have changed the title, so from you personally into the trust, that's a change of ownership, we're going to have to reapply for the homeowner's exemption. Now, here's one that's just kind of a pain in the backside, and that is, if you have the trust and you have the house in the trust, okay, and we helped you and you reapplied for the homeowner's exemption, and that's all working just fine, and you decide to refinance the house because of favorable interest rates. Okay, great. Most finance companies, most mortgage companies, etc., will have you take the house out of the trust. Okay, they'll have you take the house out of the trust, which of course is a change in ownership, put it in your personal name in order to do the financing. Parentheses, they don't have to, they just do, and it's really irritating. Okay, so they have you take it out. They'll do the refinancing. Often they promise to put it back in the trust for you. Almost as often they don't do it. So please let us know if you've done a refinance so that we can just double check and make sure that the house got back in. And if not, then we can help you to do that if you're on our membership program. And that's who this program that should be listening in. All of you that are on the membership program were invited to participate. So that's you. If you do the refinance, then more than likely we'll need to reapply for the homeowner's exemption. Again, it's not hard to do, and we can help you to do that. So just, if you would, when you do a refinance, let us know. Make sure that we're staying on top of that. Okay. So if you are where you can type into the chat, I'm gonna just shift gears a little bit, but I wanted to make sure that if you have questions, you let me know. You can ask to be unmuted, or you can put something in the chat box. All right, so I'm going to shift just a little bit. We've talked about that homeowner's exemption. I thought that the legislature could do a little bit better job for us as far as the exemption amount itself. 125,000 isn't cutting it, since a lot of property values have doubled. They could have gotten us a little bit more. That's all I'm saying. All right, so I've moved on here to what's called the circuit breaker. Now, the circuit breaker is an additional amount added to the exemption, to the property exemption, to the amount that you can reduce the value so that you're paying, less tax. And really the extent that you can reduce taxes again is up to about $1,500. And Carly in my office did the research and found that the average is around $720. That's nothing to sneeze at. So can you take advantage of that? Well, let's look at what those requirements are. Got to own a home. Mobile home will work. It's got to be your primary residence. Okay, so again, this is for homeowners, just like the homeowners exemption. This is added on to the homeowners exemption. You've got to meet one of the following: 65 and over, a widow or a widower, blind, POW, prisoner of war, disabled. That's the Social Security determination of a disability. So just one of those. You don't have to meet all of those. And if you do meet more than one, you don't get more, reduction. Sorry. You can call me and we can chat about it, but that's just where we are. Your income has to be less than about $32,000, $31,900. That's 185% of the poverty line for a household of two. You can go online and check that out. It just turns out to be 32,000, 31,900. The income definition is fairly expansive. So if you're doing taxes, if you're filing tax returns, almost anything that IRS considers income, that goes into income. So, you're withdrawing from your Social Security, of course, disability income. There's a little bit of a break, but not much. Any interest or any income off of your investments, almost anything that IRS considers income is income. So once you've added all that together, then you can actually reduce that. That's really how the circuit breaker works, is now you can reduce that income. Now you're going to have to be able to show both the income and then these deductions against that income to determine if you meet the $32,000 benchmark. So medical, dental, you can deduct that. That's kind of IRS thinking as well. Medical insurance premium. So typically that would be your Medicare premium. And if you have an Advantage plan, then you can deduct that as well. If you've prepaid funeral expenses, the year that you prepay them, you can subtract out those expenses. If you have farm or business losses, so if you're renting out the 3 acres of your property, but you're actually not making any money off of it, you've got some losses, you get to deduct those. Again, you'll have to show this. If you have early withdrawal that you've pulled out of any of your accounts, there's penalties. You get to deduct those. And if you're paying alimony, that reduces that income as well. So you add in everything the IRS thinks is income, and that's how the IRS works, right? You put all of that in there, and then you get to deduct what they tell you can deduct. And this tracks that pretty close. Not exactly the same, but pretty close. So then how does that work? Well, let's take a look. Use the same example that we had before. Assessed value at $446,000. Well, we can take out the homeowner's exemption. So that drops us down to $321,000. And then we go to the property tax rate. That gets us to $32.55. Okay. And now we can add the circuit breaker. If we've hit all those things and our income is low enough, then we get to deduct up to $1,500 on the taxes. So that drops the taxes from up here. What did we figure? It was like 46 without the homeowners. But the homeowners, it drops the taxes down to $32.55. and then we get to deduct another $1,500 if we meet all of those. And our taxes with the circuit breaker is, is about $1,755. Is that helpful? Well, yeah, it's a pretty big reduction from the full taxes without the homeowner's exemption, and then we get to reduce it even further. So that's helpful. If you're dealing with somebody, for example, that is a widow or a widower, and they've lost, some of the Social Security income, and that's what they're living off of, that number then starts to be a little bit bigger. Again, it would have been helpful if we had reduced, or if we had an increased that homeowner's exemption, because that would make a big difference if it were 150 or 175 that we reduced that by. That would have been helpful. All right, so let's throw out an example and see if I know what I'm talking about. So, couple retired, living on Social Security, at the poverty line, which allows them to take advantage of the circuit breaker. They're living on about $2,500 a month. Okay, well, $1,755 once a year, that's another $100. It depends, if their house is paid for, maybe not a big deal, but if they're making mortgage payments, that could be a little bit. That could be a pinch. Let's say that the wife passes and he loses her $800 a month. Well, we're down to $1,700 a month in income. That $1,700 in taxes now, it seems to be a bit of a bite. So that's something to keep in mind. The next time you see one of your state legislators, you can say, it would have been good if you guys had really addressed this substantially. It's a struggle. Okay, so if we do this, for those of you that don't qualify for the circuit breaker, at least we have the homeowner's exemption. I personally would have liked to see it a little bit bigger, and mainly because they told us they were going to take care of us and address that. So if you're good with that, great. If you can qualify for the circuit breaker, then you got to pay attention to your expenses, reduce your income, and that's where you are. Scott Grow, who is a state legislator, introduced and passed in the 2021 session, passed a way to defer the property taxes. So if you meet the criteria, then you could you be in a position not to have to pay the taxes right now while you're still alive. So that's kind of an interesting thought. Let's walk through that. It could work really well for you. It's just a really interesting thing for the state to do. I don't think we're the only state that does it, but it does. It's a little weird. Okay, I'll be honest with you. It puts the state and the county, taxing entities in an interesting situation. So again, let's go back. Very much like the circuit breaker, you got a home. Mobile home will work if that's your primary residence. Your combined income is $50,000 or less for 2020, and that's indexed, so that will go up. And then you meet one of the following, and they look familiar. Pretty much the same thing. 65 and over, widow, widower, blind, prisoner of war, disabled, or a vet with a 10% service-connected disability. That's a little bit different from the other one. If you meet one of those, you don't have to meet all of them. You meet one of those, and your combined income is $50,000 or less. then you can qualify for the deferral, right? You don't have to pay it till you're dead. I know that sounds a little weird because you're thinking, well, once I'm dead, I'm not going to pay it. I get that. But you don't have to pay it until you're dead, or your estate or your family won't have to pay for this until you're dead. Okay, so the question that just went through my mind as I was reading through that, right, is can we adjust down income? Let's say our income isn't 50,000, but it's 55. Can we adjust it down the way we did with the circuit breaker? And I'll be honest, I didn't see anything of that. So if you know that, let me know and we'll pass that along. And when we get off of this, if we don't have the answer, we'll figure it out, pass that along too. You'll be able to get a copy of this presentation. All right, so the deferral example. Assessed value for 2021 is 446,000. We reduce it by the homeowner's exemption. We could reduce it more if we're under the 32,000, 31,900. And then here's the tax rate is 1.014%. We talked about that on the assessable value, the taxable amount. So that puts us at 3255, just like we saw before. And so we say, no, I'm under the 50. I meet the requirements. Can I defer that so I don't have to pay it right now? And the answer is you've made it. This is the amount that you would defer, though. If you defer 3255, the rate that the state imposes on this is 2%, and then they add, and that's added to the federal midterm interest rates, which right now are 0.39% because it's really low. So the amount that you would be, or the interest that you would pay, or that would accumulate, that's kind of the point here, is 2.39%. Okay, that's what would accumulate from year to year. Well, if you program that in, say, for 15 years, and we assume for a moment there's no appreciation, no more appreciation in the value of your home, but you're going to have, taxes every year. So if you defer all of those and you add in the interest, it's just right at $61,000 is what then would be hanging out there. Okay, so just leave it hang for a minute. It's hanging out there. If you program in, I programmed in, say, 5% increase in value over the next 15 years. It seems a little, well, no, that's kind of middle of the road, I suppose. So 5%, the amount that's hanging out there's about 73,000, and if you put 10% appreciation each year, then that's much higher. And I think it's about 84,000 with accumulated interest that's hanging out there waiting for you to die. Okay, that's the state. The state is forwarding the income, the revenue to the counties. And so the state then is in a position to collect this at your passing. So a couple things to keep in mind. The lien is a second lien. All right, so mortgage, second mortgage, if those were taken out before this lien, this is in second or third position. And so those other ones will be taken care of first. In the example that we had, if we're at approximately 61,000 in, that's accrued, the taxes plus the accrued interest, that's about 13.5% of the value of your home is now deferred in taxes, just sitting out there. So what does the state do? Well, they don't know yet. it's going to be a little interesting. The way they have worked with some other governmental benefits like Medicaid is they file the lien, and then in the probate of your home, so at your passing, we open a probate in order to clean everything up and get it passed to the kids or however you dictate. Then they come in and they file a claim in the probate, right? In the probate, they file a claim and say, we need to get the money that we forwarded. We need to get that back out of the value of the house. So if there's nothing else in the probate, it's just the house, then this, of course, forces the personal representative to sell the house, to liquidate, make sure we have cash, and provide that to the state to reimburse them. And then whatever's left forward will then be distributed however the will tells us. Now, so the question that comes to mind when we say that is, well, Mark, we did a trust. We don't have to do a probate. Well, to qualify for Medicaid, you have to take the house out of a trust. The simple reason being they want to file a claim in the probate. And if you have a trust, they're going, well, we're not going to be able to file a claim. So we're going to make you, before you're eligible for any Medicaid benefits, we're going to make you take the house out of the trust. Now, for those of you that have done the Home Sweet Home Trust or planning for Medicaid, you're not going to have to worry about this. This is if you have a revocable trust and you want to qualify to defer the taxes, they'll say, yes, I think this is what they'll do. Yes, you're going to have to take it out of the, trust. Now, there's another question, and hang on just a second. I should have been a little more, paid just a little bit more attention to it. The question that I have is, all right, so if you refinance the house, or if you bought the house and you're still paying on the mortgage, then you defer the taxes, then there's a second lien. Can you do a reverse mortgage and still qualify for the deferral of the property taxes? And I saw something somewhere, and it looked to me like you would have trouble doing a reverse mortgage and be able to defer the taxes. So ask me if you're going to, if you want to do a reverse mortgage. And if you don't know if you need to do or want to do a reverse mortgage, then call us and we'll help you to, noodle through that a little bit. And we have some folks that we work with on a reverse mortgage. Okay, so that's the down and dirty on your homeowner's exemption. We really have your back on that, so you don't need to worry too much on that. We can help you. Circuit breaker, most of you will not qualify for the circuit breaker, but we can still have that conversation if you think that's where you are. You probably know somebody that could benefit from the circuit breaker. So remind them, say, oh, there's the circuit breaker. We can reduce your taxes, your property taxes. And then there's the deferral that some people, that might be a very good way for them to maintain their income level and add just a little bit back into their monthly budget that isn't going out to those property taxes. So if you have questions, let us know. This is being recorded. We're going to send you a link so that you can go back in. And those of you that weren't with us, I'm sorry, because this is always better live. But you're going to get a copy. You're going to get the link as well. You can tag into this and get to watch it. And again, if you have questions, give us a holler. This is what we do. We help out with this. There's only so much that we can do to get your taxes reduced, but we can help you walk through the process and make sure that that works for you. So those of you watching live, it is a great day with a beautiful, almost blue sky. Haven't seen that for a while. Everybody take care. We hope to see you soon, whether it's on one of these or hopefully we'll get back together and it's not 106 degrees outside in the shade. So we'll keep that in mind and have a great day. We'll talk to you soon. Bye-bye.